The two types of mortgages, what are they, and why would you choose one over the other? So, when you buy a home, it's quite usual in most cases that you get a mortgage because, let's face it, very few people have got enough money sat in cash to buy a property outright. Which means that what you do is you put down a smaller deposit and then borrow the rest of it from a bank or a building society. And then they ask you to make payments to pay it back, except when they don't. So, let's talk about the two main types of mortgages. So the first and most common type is a repayment mortgage. Each month you pay the interest, some of the capital, and then over the term of the loan, providing you make all the payments, the debt will be fully repaid. The longer term you have, the lower payments they're going to be each month, but the more interest you're going to pay in total for the length of the term that the mortgage runs. So if you have a mortgage over 25 years, the payments each month will be higher than if you had the same mortgage over 35 years, but in the long run, you will pay more interest. So that's something you have to take into consideration. Now, these are the most common type of mortgage because there is very little risk to you and very little risk to the lender, because as long as you make your payments on time, the debt will be repaid. Now, the alternative to that is an interest-only mortgage, which means that each month you're paying the interest, but you're not paying anything off the debt. So at the end of the term, 10 years, 20 years, 30 years, you still owe exactly the same amount you borrowed. Now, in the old days, these were reasonably common because people would have investments like endowments and things to pay them off. But the problem was that often the investments didn't perform as people expected. And then they got to retirement and suddenly there wasn't enough money to pay off the debt. So they've become a lot harder to get hold of, but they are still out there. Now, two main reasons you might want one. One is that you are planning to downsize in the future. So say you have a house that has a massive amount of equity in it and you're only planning to stay there for another 5 or 10 years and then you're going to sell up, move somewhere smaller. It might be worth thinking about interest only if you want to keep your payments down and if you can find a mortgage lender that will help you do that. The other option is if you are renting a property out, say you're a landlord and you buy a property you want to rent out and put tenants in it, then often you'll use an interest-only mortgage because it allows you to have more cash flow each month, and it also means that at some point when you sell the property, you will then pay off the mortgage and you'll have this nice lump of cash. Hopefully, if the property's gone up in value, you will pay some tax on it, but it doesn't really matter you haven't paid it off in full because it's not somewhere that you live. It's not going to affect your home. Now, getting an interest-only mortgage can be tricky because lenders are more wary because there's more of a risk that something can go wrong. And that's where working with a qualified financial advisor is somebody who will be able to point you in the right direction as to whether this could be a good option for you and whether or not there is a lender out there that will accept your circumstances. So there we are, the main types of two different mortgages.